Let's take a look at what is moving on markets at the moment. We talk about animal spirits. Well, they're certainly playing out at the moment. Marc Wait is the CIO of Providence Wealth. He joins us now. Marc, good to see you.
Nice to see you again, Andrew.
Animal spirits, certainly alive and well at the moment. Can you recall a market or markets like this at the moment where it's pretty much everything rally?
Absolutely, and I think what we sort of noted at the end of the sort of second quarter was some very solid foundations there. So we clearly had a lot of ructions in markets with the Trump tariffs in the beginning of the second quarter, but we think what was quite remarkable was the way in which markets have performed very well, and I think it's really around those solid foundations. So when we talk about solid foundations, we look at things like policy being very supportive, fiscal policy globally has been reasonably expansionary, monetary policy is in an interesting space at the moment where we're not necessarily particularly worried about a recession coming, but you are seeing some easing in policy, or in countries like Japan where they're keeping monetary policy very easy, so that's very supportive. Underlying that, if you look at the sort of company earnings in the US, we've had significant beats in terms of company earnings, and I think what's also quite pleasing is, as opposed to it just being a story of US exceptionalism, you've started to see a lot more broadening in terms of that earnings story. So earnings getting better in terms of expectations in Europe, in Japan, and then also in emerging markets. And so we're probably a little bit less in that sort of frame of a very narrow market, and we're seeing some more breadth. Interesting to see that sort of emerging markets has actually outperformed the US markets this year.
On that note, how do you view the Australian market then in comparison?
Yeah, so we're a little bit cautious, and I think some of the notes that people have been making has been really that sort of relatively sluggish earnings in Australia. Valuations are quite high, so if you look at the ASX 200 level, that's sort of pushing up against 20 times PE ratio, and that's really in the top decile of where it's been over the last 20 years. So a little bit expensive there. So our bias has been very much to be overweight internationally, globally, and to have a little bit of an underweight towards Australian equities on that valuation type measure.
And I know that you're reinforcing the importance of diversification at this point.
Very important at this point in time, and I think it's around having a progress stance in portfolios but being responsibly bullish. And what do we mean by that? Well, the cost of diversifying at this point in time is relatively low. I mean, if you look at PE ratios in the US for large cap tech, they're above 30 times in the NASDAQ 100. If you look at the S&P 500, that's sort of in the mid 20s, whereas when you move out to other markets like Japan, that's trading around about 16.5 times earnings, 16.5 times PE. If you look at Europe, that's around about 17, depending on which measure you look at, and emerging markets around about 15. And when you actually look at the earnings across a lot of those markets, they're reasonably comparable to what you're getting in sort of S&P 500 type earnings over the next 3 years.
Interesting you mentioned Japan there. Excuse me, has your view changed over the past week or so, given we have the new leadership there?
Yep.
The Prime Minister-to-be looks as though she's going to take up the mantle of Abenomics, quite conservative, the prospect perhaps that those interest rate hikes are maybe not going to materialise.
Yeah, so Japan's been a significant overweight for us for a long period of time, for around about 4.5 years. And we've been expressing that in a number of different ways, both through sort of owning a broad basket of Japanese equities, but also through a Japanese activist manager. And you mentioned Abenomics. And I think what's really interesting about the Abenomics story is that you're continuing to see corporate change in Japan, and it's continuing to drive value. So one of the policy measures that the new Prime Minister has mentioned has actually been putting a tax on companies holding too much cash on their balance sheet. So continuing to sort of free up some of those stranded assets on balance sheets, whether it be cash or real estate, and hand that back to shareholders. So not only do we think the valuations are reasonable at the broad market level, but with the right manager you can actually harvest some of these Abenomic measures that have taken place in an environment where policy is pretty supportive.
And Marc, elsewhere you mentioned emerging markets. Where are you seeing the opportunity at the moment?
Yeah, so we think it's important to be quite specific, and the manager that we've chosen there tends to have a sort of quality bias in terms of their portfolio with a little bit of a value tilt as well. And so we think there's some really interesting opportunities there. So where the managers have been a little bit cautious has been in markets like India. So that you look at the valuations in India, they're quite high, but in a lot of the other emerging markets, they're quite reasonable. So Latin American markets, reasonable valuations. In parts of Asia, it's a cheaper way to be invested around that sort of technology trade. And so we're seeing quite a lot of opportunity there. I mean, one of the markets that our managers had a reasonable exposure to has been Greece, and overnight that was upgraded from emerging market status to developing market status.
I also know that you're pretty cautious on private equity. Why is that?
Yeah, so we wrote a piece sort of earlier in the year just around private equity, and I think it's no secret, there's a lot of stories in the press that probably the vintage private equity funds that were raised in 2021 will probably have quite poor performance in aggregate. That's not to say that you won't have some top tier managers that will do very well, but in aggregate, arguably, a lot of those deals were priced on a world of zero interest rates and quite high valuations. And in line with that, exits have been pretty tough. So whilst we have started to see the IPO window start to pick up a little bit, there's a lot of assets to be moved out of private equity at relatively high valuations, and potentially the valuations haven't come down yet. And we just think there's more attractive areas in alternatives than private equity at this point in time, particularly given the strong performance that you've seen in public equity markets, and particularly given those opportunities that we see ahead for a diversified global equity portfolio.
And Marc, everyone has a view on gold at the moment.
Yep.
Interested to get yours, how you're positioned.
Well, we've got a strong view on gold, so we've owned it in our clients' portfolios since 2019, and we have around about a 5% exposure. And I wrote something around about 18 months ago, which was gold no longer a barbarous relic. And the idea there was really around the important role that it was playing in portfolios from a diversification perspective, and also the fact that if you think about that long period of reserves for currencies of actually not owning gold, you started to see the corner turn in that space. So if you look at the allocation in terms of current market value, it's around about 15% of global reserves. It's pushing up against the same sort of level as US Treasuries in the global reserve mix. And from my perspective, I just think there's quite a long runway in that space. I mean, interestingly, in a former life, I worked in the sort of official sector in a sovereign wealth fund, and we did quite a lot of work at sort of looking at physical gold at that point in time. And it was very interesting talking to some of the different reserve managers around the world. There was a deep sense of regret that the gold weighting wasn't high within their portfolios. And that's really what we're seeing now. And I think things like the Russian reserves being taken over have moved things back. And then interesting, I think in the retail space, you saw a period from 2021 until the early part of 2024 where actually the amount of ounces owned in ETFs was reducing. It went from 110 million ounces down to 80. Recently, we've started to see some more money flow back in, but it's still not back at that peak that we saw in 2021. So we're cautious. We've had very strong performance that we've seen, and probably it's not going to be possible to see another year of 50% increase in the gold price.
But we do think
we've been trimming, yeah. So as you could imagine, with the high price appreciation, some of the weights in our client portfolios have moved up towards sort of 8%, and we trimmed it back to sort of 5%. But with the moment, we're sort of hotly debating it, but we still think it has a reasonable role over time with those structural tailwinds. So you may get some solid ups and downs, but we think over time there's some supportive tailwinds for it.